Good day, guys. We'll be doing IFRS 15 revenue from the contract with customer video today. And the first clip we'll be having will cover the objective, the scope, also the definitions, and step 1 of IFRS 15. Okay, if we move to the objective of IFRS 15 is to establish the principles that an entity shall apply to report useful information to users of financial statements about the nature, the amount, timing, and uncertainty of revenue arising from contract with customers. If we talk about useful information, it means that we have covered usefulness of information under the conceptual framework. Then, the point of IFRS 15 is to achieve the same goal which we had on the conceptual framework, that the information is useful to the users of the financial statement. And then, the next part is about the exclusion on IFRS 15. This standard does not apply to contracts with customers arising from the following: lease agreements, insurance contracts, financial instruments, and last but not least, non-monetary exchanges between the same line of business. For example, if the companies are selling the same goods and then there's an exchange which is non-monetary, we are not going to recognize revenue in such a transaction, or we're not going to account it in terms of IFRS 15. We're going to talk about identifying the contract with a customer. The step number 1. The definitions which are important at this stage are revenue. Revenue is income arising in the course of an entity's ordinary activities. When we define revenue, we need to underline income. Income also is from the conceptual framework, which means that there's an increase of economic benefits during the financial period, which will lead to the increase in assets or decrease in liabilities, other than the contribution by the equity holders. Then, if we look at the second one, the second definition which is important at this step are the contract. A contract is an agreement between two or more parties that creates enforceable rights and obligations. We need to know these definitions. Also, the third one, which is important, is the customer. Customer is a party that has contracted with an entity to obtain goods and services. The customer will be receiving goods and services, and then these goods are an output of the entity's ordinary activities. In exchange, the customer has to pay the consideration. For now, we'll focus on 3 definitions: the one for revenue, the one for contract, and the one for customer. And then let's move on to step 1. Identifying contracts with a customer. There are 5 criteria which needs to be met. All of them need to be tested. In terms of IFRS 15, for a contract to qualify, number 1, the parties to the contract have to approve the contract. This could be in writing, or this could be as a normal business practice. If it's not explicit, it will be implied. Number 2, the entity can identify each party's rights in terms of the goods and services to be transferred. We need to identify the rights. And then number 3, the entity must identify the payment terms for the goods or services to be transferred. And then the fourth one, the contracts must make commercial substance. There must be a commercial sense in the transaction. We must know the risks, we must know the timing, and then how much future cash flows will be. And then the last one, the last requirement, it is probable that the entity will collect the consideration which is entitled to in exchange for goods and services that will be transferred to the customer. All these criteria must be met. If one of these criteria is not met, the contract needs to be reassessed. There must be a reassessment of the contract in terms of those 5 criteria. And then the other condition we might have, a customer might have paid the money, but some of the conditions are not met. Then it means that the only time the company will recognize revenue, it's when there is no remaining obligation to transfer goods or services to the customer, or the company has substantially transferred what it has promised to the customer, and also the amount is non-refundable, or the contract has been terminated and then the amount is non-refundable. We have 2 conditions. If the criteria are not met for the contract, and then the money has been received, the contract is non-cancelable, and then the company has no remaining obligation, or the customer has terminated the contract and then the money is non-refundable. And then the entity shall recognize consideration received from a customer as a liability if none of the 2 situations I have mentioned, in terms of non-refundability and then the termination, and also no remaining obligation. Lastly, in terms of step 1, students need to be aware that the contract may have no fixed duration, and then it means that there will be modification, and then it can be terminated at any time. And second, the student needs to be aware of the automatic renewal of the contracts. Okay, I would like to thank you guys for watching this clip. Make sure that you watch the next coming ones.